Good afternoon. This is Jed Brewer with Study Groups and the Below the Line Club. Really excited to have you on the call today as we are going to be talking about making money with credit cards. I know for many of our study group members, credit cards can be a pain point because so many people, or customers I should say, make purchases on credit cards and we have to pay the interchange fees on those, and they can be fairly expensive at the end of the day. And if we look at our expenses as a percent of gross profit, for people that are involved in retail, I would say it's often one of the top three expenses in dollars. Payroll would be number one, but it's usually down around number three is where credit card fees sit in. And for people that are less in retail and more business to business, like a lubricants distributor or so forth, increasingly credit card fees are becoming a higher expense for us. So really pleased to have Larry Gildersleeve and Ryan Howlett on the call today, who are going to talk a little bit about interchange fees and what we may be able to do to better manage those fees and to drive them down. Alternatively, sometimes as firms, we sit on the other side of the transaction where we're actually making payments to vendors that we do business with. And there's a big opportunity for us, like our customers do with us, for us to be able to pay our vendors with a credit card or virtual card, probably the better term, and get rewards or benefits from that payment. And so Gary Ligori is going with Control Payables, is on the call today to share with us just a little bit about how firms are using to their advantage virtual payments like a credit card to drive more dollars to their bottom line. So we're going to look at both sides of the coin here today, both the payable side with Gary and then also the reducing the expense that we incur when our customers pay with cards with Ryan and Larry. So should be a great webinar. Really appreciative to have you and them on the call today. Just a couple things as we go through the presentation. If you have a question, I would invite you to type in the GoToWebinar dialog box your question. I'll be able to see that, and I can relay it on to Larry and Ryan and Gary at the appropriate time. And we're going to spend probably the first 30 minutes of this hour-long call with Larry, Ryan, and Gary kind of sharing from their perspective. And then we'll spend the last 30 minutes or so with just open discussion, Q&A time to be able to get your questions answered for them. So hope you find this to be a very educational time, and we'll go ahead and dive right in as we get going here. So I want to introduce Larry Gildersleeve with Customized Solutions, and Larry's going to share a little bit more about him just briefly, and then introduce Ryan Howlett with Payrock. So Larry, I'll go ahead and turn the floor over to you.
Well, thank you, Jed. It's certainly our pleasure to be newly associated with Below the Line Club. I'll take just 60 seconds for an introduction. My business partner, Jeff Seitz, and I spent most of our combined 60-plus years in the business world in the resort and traditional hospitality industries. I think we make a great team because I was a corporate guy holding executive positions with large public and private companies, and Jeff was the entrepreneur who co-founded Trend West Resorts in Seattle in 1989. Trend West was a startup, initially capitalized with only a few $100,000 that was taken public and eventually sold to Ascendant, which is now winning for almost $1 billion. In our search for ways to increase profitability of hospitality companies, we began focusing on credit card processing almost 6 years ago. Although it's vital to virtually every business, it's certainly neither sexy or glamorous. So we found most merchants don't focus on the cost component. And when they try, they discover, as we did, that card processing companies don't want merchants or the merchants' customers to easily be able to understand the costs they're being charged. This intentional lack of transparency is a sad commentary on an industry, but it's a true one. So Jeff and I formed Customized Solutions in order to increase client company profitability without the need to increase their revenue or decrease any other expenses besides their credit card processing costs. We've done this by forming business development relationships with companies, many of them publicly traded, that in the aggregate process over 90% of all credit card processing in the United States, and we also operate internationally. Our strategic partner selected for members of Below the Line Club is Chicago-based PayRock, one of the largest entities of its kind in the United States. As Jed indicated, Ryan Hallett from PayRock is with me on the call today, and he'll be leading our presentation. We selected PayRock because of their best-of-breed professionalism, the depth of their resources, their commitment to excellence in both B2B and B2C customer service, and their willingness to invest human and financial capital to meet the expectations of members of Below the Line Club. And it's important for you to know our goal with each member is to exceed their expectations. So with that, please allow me to introduce Ryan Hallett, PayRock's co-founder and its Chief Revenue Officer. Ryan?
Thank you, Larry, and thank you, Jed. It's a pleasure to be on the phone with you guys today. Today we're going to dive into credit card processing, interchange, some of the convoluted ways that some of our competitors in the marketplace has positioned ourselves, and hopefully bring some clarity to the overall idea of, you know, where this large amount of money on a monthly and annual basis is going. So with that being said, this is Ryan Hallett. I have about 16 years in the payment space. I am one of the co-founders of PayRock, and I'm also a certified payment professional. And why that's important is there's a lot of folks out there that you may have spoken to in the past, a lot of companies, a lot of what we call sales agents or sales representatives that have gotten in this industry and really didn't understand all the different layers. And what the governing body in our industry is called the Electronic Transaction Association, otherwise known as the ETA. And years ago, I was blessed enough to help develop a test about 8 years ago that is now called the Certified Payment Professional Test. And what that is it's an accreditation in our industry, like it would be for in the legal field, the bar or real estate. It's basically an accreditation that kind of weeds out some of the what we call fly-by-night people, or people that just jump in this industry to jump back out. So it's something that we really like to hang our hat on because it does separate us a lot from our competition. And within our organization, no matter who our clients deal with, we make sure that all of our what we call payment professionals are certified payment professionals accredited with the ETA. So with that being said, a little bit about PayRock, just to kind of give you an overarching idea of what we do. We are a full service acquirer. What does that mean? That means that we don't outsource anything. We are actually one of the only providers in the United States that does everything from underwriting, risk management, terminal deployment, statementing, reporting, chargeback management. That is all done within our corporate walls. None of it's outsourced to any third party. And it's something that's very unique in our industry, as a lot of the big boys continue to acquire and grow. They tend to outsource a lot of these capabilities, where we feel like it's super important to continue to house that in-house. So that's a little bit about me and who PayRock is today in the marketplace. What I really want to get to, what's going to be important to you guys, is interchange, right? What is interchange? Now, this term you may have heard before in our industry. I know this term is used in other industries as well. But basically, interchange is the cost that businesses pay to process a credit or a debit card. And there's three components that I want to talk about real quick that go into interchange. There's three parties involved. And let's start with the biggest player first and foremost. It's the credit or debit card issuer. That is the financial institution that issued that credit card or debit card to your customer's wallet. And we all, as card holders, obviously hold cards in our wallet too. So card issuer first and foremost. Then we have a card brand that could be Visa, MasterCard, Discover, or American Express. And then you have a payment processor, a processing company. They're the folks that are contracted to move the money. You cannot process a credit or debit card without all three of those players being involved. Okay. And with that being said, let's take a look at interchange as it is on this slide. There's a couple of hundred different types of interchange rates out there today. My wife, she holds a Capital One, no hassle miles card in her wallet, and I hold a Chase Preferred Sapphire card. Each of those cards have a different interchange rate, and the interchange rates all vary based on the rewards or the perks that we get. So for example, a lot of you folks may shop at Costco or Sam's Club, and they say, well, we only accept debit cards or check, and it was American Express for some time. And the reason being is debit cards are the least costly form of acceptance for a business. So they would price themselves out of the market if they took my wife's Capital One no hassle miles at an interchange rate of 2.95% and 10 cents. Okay, so interchange can be anywhere from 5 basis points all the way up to 3%. And there's two components of interchange. There's a percentage based and then a per item fee. Okay, so your statement that you get every month is composed of all these different interchange rates that you've accepted, which is the card brand, the card issuer, and your processor. So here's a little bit of a graph that I wanted to show. If someone was going to come in and purchase $100 worth of fuel, okay, roughly about 11 basis points goes to the card brand. So at the top left-hand corner, you can see about 11 cents of the 100 goes to the card brands. If you take a look below that, the lion's share of it, as we talked about, is the issuing bank who issued the card. And then up towards the middle in the yellow, you'll see what goes to the merchant account provider or the credit card processor, i.e. a payrock, right? That's the cost that they charge on average to move money. Let's talk about accountability. This is where I want to focus really on the most. You know, what do we know in our industry? Well, we know that over the years, credit card processors who are majority owned by banks, okay, have done a very good job of being deceptive on how they bill and how they price. And over the years, the market's wisened up. You know, years ago when I first got into this industry, and a lot of you may remember, a tiered structure where you had one rate for debit, one rate for credit, one rate for rewards cards. That was kind of the standard. And what happened was a lot of the big boxes came along and said, hey, we want a much more transparent way to understand who we're paying and how much. So the market came out with Interchange Plus or Cost Plus, Wholesale Plus, you may have heard of. And majority of you, I'm assuming most all of you, are probably on some type of Interchange Plus program today. Now, Heartland really did a good job bringing clarity to the market and how they did their statementing. And what I mean by that is how they presented their statement. You know, there are teams of people that sit behind a closed door in a boardroom and think of more convoluted ways to propose a statement. So sophisticated CFOs, business owners, controllers don't understand exactly who they're paying and how much. And they just kind of chalk it up to, well, you know, it's a 3.5% or it's a 2.5%. That's just what we pay. Well, that doesn't necessarily have to be. So basically, who's accountable for this? And I wanted to take a couple of bullets off of two of the largest payment processors out there today. And if you look at the screen you see in blue here, E from processor A, we may amend this agreement or change fees, charges, and or rates at any time. You do not have the same right. We will provide notice of change in accordance with the notice section of this agreement. Processor B, 25.5, subject to section 30.3, we may also increase our fee for services for any reason at any time by notifying you 30 days prior to the effective date of any such change or addition. So majority, all of you, unless you guys took some time or your legal counsel took some time to strip out some of this language, which majority of the time that's not the case, these processors hold the right to pull a lever, a trigger, to increase what you pay based on how they see fit. And that's really kind of the meat and potatoes of how these processors take advantage of merchant relationships. And if you're not looking at your statement, if you're not having someone sophisticated monitor your statement every month, there can be small nuanced fees, fractions of pennies that they're pulling that can equate to, you know, tens if not hundreds of thousands of dollars a year, depending on your processing volume. Okay, so they do hold that right. So I wanted to point that out. I thought that was very important. Okay, so let's talk about interchange management. You know, there's very few firms out there that focus on interchange management. Payrock, this is probably one of our claims to fame, to be honest with you. We've always kind of touted ourselves on interchange management, and there are some firms out there that do a very good job of this that we highly respect in the industry. But basically what interchange management is when you're with a payment processor that has the right data, that every month systematically can review what you're paying to interchange, and then also come back with detailed reports explaining how you can improve your interchange. So I'll give you 2 examples of that. We do well in the furniture space. So we have furniture stores, and they have a lot of turnover. And when you're buying something at a furniture store, a lot of times things are done over the phone, okay? And when things are done over the phone, as you know as a cardholder or e-commerce for that matter, they ask for a billing zip code and a billing address verification, and a 3-digit code on the back of your card, your CVV. Now, if that information is incorrect or not provided, the card issuer will downgrade your sale by up to about 60 basis points. Let's just call it 0.5%. So with that being said, for example, in this furniture store, every month we give detailed reports saying, hey, at terminal number XYZ at this time, we have found that you're downgrading your sales about 65 basis points on about $100,000 of volume this previous month. And we can narrow that down for the merchant, and then the merchant could then go ahead and correct that with their staff. Maybe it's someone that wasn't educated properly, that didn't know what to ask for. Or maybe it was just an employee that was being lazy and just simply not asking for the information. Another example of that is in the B2B space. Some of the, if there's some lubricant distributors on here, there are certain card types that you may be accepting that these card issuers change the parameters of what type of data they want to accept. Now, they don't necessarily notify anyone about this. So what we do is with our interchange management service, we monitor these transactions every month. And if we see a flux where there's a specific card type that was qualifying, it's called a 2%, jumps up to a 2.5%, we investigate why there was an influx. We figure out the reason why that card went up. And then we get with our merchants to explain them what that was and how they can correct that, right? So, a lot of folks will say, well, interchange is interchange. It's the X variable. It's just what we pay. It doesn't necessarily have to be. The big banks and the card issuers want you to think that, right? Which is why you don't hear a lot about interchange management. They try to suppress this type of information from the general merchant public because it's really just revenue out of their pocket. So if we have any bigger B2B merchants on the call and you haven't taken a deep dive with a certified payment professional to take a look at what you're paying in interchange, this may be a good opportunity for you to take a look at that. Okay, 11 minutes, so a few more minutes here on this. Couple other things that I wanted to make privy to the team on this call. A few companies out there are doing same-day funding. And working capital may or may not be a big deal for your business unit. But if it is, and you're looking to get paid faster, there are programs out there, PayRock does offer one of them, that is same-day funding. So if your C-store or your pump closes out at 4 a.m., okay, this day's Tuesday, so if it's 4 a.m. on Wednesday, tomorrow, you'll get paid those funds the same day at no extra charge. So if working capital is something that's, that is significant to you or your business unit, your downlines, this is something that's out there. PayRock's not the only one offering it, but I wanted to make it known that there is same-day funding, which is fairly new, a few months old into the industry and quite new as a whole, considering there, years ago it was a 72-hour, 48-hour turnaround time. And then in addition to that, cash discounting is becoming more and more accepted in the United States of America. Paying at the pump was the first to do it years ago, but it has taken off like wildfire in the C stores. We're seeing a lot of convenience stores doing a cash discount program where basically these merchants, these business owners are paying $0 to process cards in their C store. So if a C store management team decides, we don't mind passing on a very small fee to our cardholders to be able to pay by using plastic, this is just something that we deploy a terminal, we provide you with the signage, and you go from paying 2%, 3% to literally paying $0. So if that's something of interest with you, the cash discount program, you're going to start seeing it more in convenience stores. You're going to start seeing it more in even more upscale restaurants and boutiques, things of that nature. You will run into this. You may not even notice it. I was on vacation a couple of weeks ago. I bought a bottle of wine for my wife and I looked at the receipt back at the hotel and I said, oh, geez, look at that. They got me for $3 on a cash discount program. I didn't even notice it. Now, I didn't mind paying it because I'd rather reserve the cash in my pocket to pay someone, to tip someone. or something like that, or a cab. So I didn't mind it, but you know, I didn't even notice it at the point of checkout, and you probably will be the same. So keep your eye out for that. And if credit card fees or fees in general are just really becoming burdensome, and you guys are looking for a way to kind of subsidize that, a cash discount program may be something that you want to explore or at least test for a couple of months. And if it's not working out and you're getting a lot of pushback, you know, it's something you always switch back to your normal means of business.
So Ryan,
and at the end, yes.
Quick question on the bottle of wine example you gave there. So the menu price was $100, say, for the bottle of wine, and then your receipt was for $103, $100 for the menu price plus $3 for the credit card charge.
Great question. Yeah. So basically, the way the cash discount for it's a little bit different. That the way the card brands have you work this is there is a service fee tacked onto every sale at the point of sale. Let's call it 3%. And if you choose to pay with cash or gift card or check, the service fee is then removed. So when I bought my bottle of wine, say for $100, there was a $3 service fee that was not removed because I did pay with my card. Had I paid with cash, okay, the $3 service fee would have been removed.
So how did that display on the receipt?
There's a technology in the terminal. There's a code written in the terminal that calculates that math. That is the secret sauce of a true cash discount program, because if you're not calculating on the receipt the proper way, and I could send an example to the collective team here of what a receipt looks like. If you're not displaying it and messaging it the proper way, the card brands look at it as surcharging, which is considered a no-no.
Mm-hmm.
So really, it's a service fee tacked onto every sale, and if a consumer chooses to pay by cash or ACH, the service fee is then eliminated.
Okay, thanks.
Sure, good question. So what you deserve, whether it's with PayRock or any payment processing, truly, there shouldn't be any complex, confusing charges in your statement. There should be no hidden fees. You shouldn't have to monitor these things every month. You should have a team that's doing it for you. You know, at PayRock here, we work as payment professionals, as trusted advisors to find the right payment solution to help people grow their business. You know, the days of here's your desktop terminal, call us if you have a problem, those days are so far gone. Today we deal with, hey, I'm a petroleum merchant that sells fuel at the pump, but we also have an online presence because we have these tchotchkes that just people love and we sell them online, but we also have some needs for doing these offsite things where we need some wireless credit card terminals. So really, payment processors today, if they're not becoming more advisory and they're not becoming more of a payments partner versus just a payments vendor, you may be with the wrong company, because it's becoming more of a partnership today than it ever has so been, than just a, here's your terminal, you're going to get a statement every month, call me if you have an issue. Those days are slowly fading out. And, you know, if you guys ever have a need to explore this or want to see what interchange management can do to your bottom line, we're here to do that for the collective team.
So Ryan, can you flip back to the pie graph that you had there for a second that I think showed where the total fee goes to the various providers?
Yeah.
So I see 98% of the fee is going to the issuing bank. And kind of the services that you're talking about, quote unquote, interchange management, where is the biggest opportunity to move the needle, I guess, so to speak, or ultimately save money?
So it's in the biggest portion, the green portion. And it's not on all of the cards, right? So specifically, for example, lubricant distributors or heavy B2B folks. There's the issuers in a business-to-business transaction, no matter who comes in your store and they pay with a business card, and you're obviously a business. If you don't provide a tax amount of that sale and also send a 7-digit random invoice number, there's about an average of a 65 basis point downgrade. Okay, so what we do is we'll take a look at that and say, hey, look, 80% of your sales are business to business, and these 2 bits of information are not getting passed through to the issuer, therefore they're downgrading the sale. So we have proprietary systems that will actually send the transactional data on your behalf to make sure that you're getting the lowest possible interchange qualification on that sale. So our interchange management really focuses on this green part, which is the majority of folks' bill.
Makes sense. Yeah, thank you. And a question from somebody in the audience here just quickly, but they just said, are convenience and petroleum POS solution providers like a Gilbarco or Verifone, are those set with their software to handle the cash discount that you were describing, like in the case of your bottle of wine?
Some of them are, and some of them aren't. The ones that aren't, we do have roundabout solutions, standalone terminals. And the good news about the standalone terminal situation, it kind of gives folks the ability to kind of test the waters, dip their toe in, and see if it works. And if it's something that they really like, we'll actually work, our team will actually work with the point of sale or equipment manufacturer to help them write the specific code to make sure that the cash discount is displayed properly on the receipt, so they're with it, so that they're within compliance with the card brand's rules and regulations.
Mm-hmm.
So there's a couple different ways that you can kind of skin that.
Makes sense. And then just my own curiosity here. So if you have a firm who gets serious about managing interchange, how much opportunity is there to move the needle? I mean, is one able to save 5% of the total spend by managing 10%? I just trying to get a feel for
it really depends. It's a great question. It really depends on the merchant and the cards accepted. Each merchant is kind of a little bit different. So without taking a look at a statement to really flush out how much business to business transactions they're doing versus B2C, it's really hard to tell. For example, like restaurants, things is what we call travel and entertainment, T&E merchants. They're not able to do any type of level 2 processing. The card brands don't allow for that. But I'll give you a specific example. We had a client last year that we brought on, a big concrete company in the Midwest, and they were processing about $2 million a month in transactional volume. And without moving their processing pricing, meaning we matched what their processor was giving them on an interchange plus or a cost plus program, the plus part stayed the same. We were able to save this concrete company $950,000 over the course of 3 years just by implementing interchange management that didn't cost us or them a thing to do. So that, that's a really good success story for us, for a merchant, processing a substantial amount of volume, but nothing crazy because, we do have merchants processing tens of millions of dollars a month. So the success story really, it's hard to tell until we take a deeper dive into the cards that are being accepted because there's hundreds of them out there.
Okay. Well, thanks, Ryan. I want to jump over to Gary Ligori here briefly, but we'll come back with Q&A time. So for the audience, I encourage you to type in any questions in the GoToWebinar framework, and we can circle back with Ryan and get some clarification on those questions later. But Gary, I'm going to flip the controls over to you so people can see your screen on their computer. And I know you focus on the payable side of how people can use credit card to ultimately drive more dollars to the bottom line and take advantage of paying with credit cards. So Gary Ligori.
Okay, thanks, Jed. Ryan, great job. Complicated subject, and you really cleared a lot of things up, I think, for everybody. So that was excellent. So I want to talk about your accounts payable department and a little bit about what Control does to help businesses. So what Control does is help reduce AP costs by reducing the volume of checks that are written to suppliers and converting those electronic payments through a virtual credit card or through ACH. These are processed through your existing accounting system, and they're delivered electronically. So when you pay with a virtual card, you get a significant rebate, and that can more than cover your cost of operating your accounts payable department. So U.S. businesses now are still paying about 70% of their accounts payable invoices by check. So this is really the most expensive way to pay your suppliers. You have the cost of the check stock, envelopes, postage. You also have the cost of the time spent printing, signing, stuffing, and mailing these checks. And then you have reconciliation and bank fees as well. So some studies are putting the average cost of issuing checks at almost $6 per check. And there's also a cost associated with outbound checks in both time and money. And an inbound check cost also exists for your suppliers, as well as reconciling payments. So checks are also not very secure. Every time you mail a check, you're mailing out a piece of paper with your account number on it. And of course, a check does not generate any revenue or rebate. So ACH is the other common method. It's better than a check. On average, it's about 1/10 the cost of paying by check. And while the cost is significantly less, there's still a cost. Additionally, suppliers bear the expense of employee time spent manually processing each card transaction. In fact, the typical cost of an ACH transaction for the supplier is about 62% higher than the cost of receiving a virtual card. So one of the reasons for that is the remittance advice sent with an ACH payment is usually insufficient for automatic processing. So the ACH remittance data is usually sent separate from the invoice, and that complicates the reconciliation process for your supplier. ACH is more secure than a check, but you're still exchanging bank account information with your vendors or suppliers. Of course, just with a check, ACH payments don't generate any revenue, so there is no rebate. So today we're talking about a third option for paying your bills, and that's with a virtual card. So virtual payments is a payment alternative to check and ACH designed specifically for paying your suppliers. It uses your existing accounting system, does not require any change in banking relationships, and leverages single-use virtual credit card account numbers. You get all the benefits of paying by check or by ACH, but with none of the disadvantages. So why it's the best of the three? This is why we feel it's the best. There's no cost whatsoever. There's no implementation cost, no per transaction cost. There's no cost, period. With virtual cards, the payment information is sent by email and includes a complete detailed remittance information and typically does not require any manual processing. Third, with virtual cards, the single-use card number is valid only until the payment is processed, preventing fraudulent and unauthorized charges. And fourth, it reduces employee expenses, mainly because we're going to move a lot of that 70% of the vendor spend check payments over to a virtual card, and that's done for free. So checks are the most expensive. If we can move those down the line to a much more efficient method of payment, you're saving money. And of course, the last thing, the biggest thing, is that with a virtual card, you're generating a rebate through revenue that comes from control. Checks and ACH do not do that. So the virtual card is going to generate 150 basis points. So that's $150,000 on every $10 million in AP spend. And that's $1.5 million on $100 million of AP spend. So it's significant money. So we talked a little bit about what virtual cards are. So let's talk a little bit about what they won't do for your organization. So it will not change any of your current processes. It's just a new payment method. There's no need to change or modify your accounting software. No need to change any banking relationships. There are no setup fees, no monthly fees, no per transaction fees, no long-term agreement. And it's not any work or project. It's not a project for your team. There's no additional work that they have to do on your team side. So we find that about 80% of all suppliers are currently accepting credit cards from their customers. We really just help organize the payer suppliers who are already accepting credit cards for payment. So let's talk a little bit about what Control does with our partners. So we have an expertise in working with every major accounting system on the market. So it's a cloud-based system. It works with your existing accounting system. There's no need to change that. I want to stress that because that's the most common question that we get. This is the largest platform in terms of participation by users and suppliers of any platform of any bank. Control processes over $90 billion annually, and there are over 20,000 organizations or businesses that are paying over 1 million suppliers that are accepting virtual cards through the platform. So the over 20,000 represents businesses of all sizes, the U.S. Post Office, as an example, many universities, municipalities, cities, school boards, billion-dollar companies, down to $10, $20 million companies. So let's talk about how your suppliers would be approached and how they can be a part of this. So we have an enrollment team that helps transition your checks to virtual payments and maximize the number of suppliers who accept virtual payments from you. We place an average of 4 to 5 calls to each of your suppliers. We reach them until they understand what we do, and they can make a decision on whether they would like to accept the virtual payment. We call 100% of your suppliers. If they decide not to participate, that's fine, but they are given the option. We also will ask them if they don't want to accept virtual cards, if they would be willing to accept an ACH. That way, it's still reducing your cost, but we do that for free as a value-added service. So banks who also sometimes process virtual payments are not really set up to do this. So typically, they will have about 2 to 5% of enrollment for an average of about 4%. What Control does by calling all the vendors and reaching out is able to convert 25 to 30% for an average of 26% of conversion. This saves you time, saves you money, and generates that significant rebate.
And
it's really a
percent, Gary, just clarification, you're saying percent of vendors that you're doing business with. Is that right?
That's a good question. It's actually 26% of the volume of the accounts payable. So it's actually a bigger percentage of vendors that or suppliers that will accept the virtual card, but in actual dollars, it's 26%.
Okay. And for banks, you're saying that number is around 4% of the AP spend. Okay.
Correct, because banks will typically, they're not set up, they don't have an internal infrastructure to make the calls that Control will do, to reach out to the vendors, explain the process, and to have them signed up. So let's talk a little bit about the banking partners for Control. There's 4 banks that we use: Heartland Financial, the publicly traded bank, named the Forbes Best Bank for 2017 and 2018, and one of the largest commercial credit card issuers in the country. Second bank is Central Bank, and that's ranked in the top 20 by Forbes. Third bank is Regions, with over 21,000 employees and over $125 billion in assets. And then the fourth bank is U.S. Bank. U.S. Bank is currently ranked as the 7th largest bank in the U.S. So those are the banking partners. We do some things internally to figure out which is the best for you, but they're really just in the background, and they're there to safeguard the money and process the payments. All right, so let's talk a little bit more about what Ryan spoke about, and that's the interchange fees and basis points that have been discussed. So just to use a simple example of a $100 purchase, and we're going to use the average of 2.5%, so $2.50 over that $100 transaction. So as Ryan pointed out, there's going to be a few cents going to the processor. There's going to be a few pennies paid out to Visa or MasterCard. And then in this example, we're going to say there's $2.35 remaining for the bank. In this case, the bank is going to issue 150 basis points, or $1.50 back to you for your rebate. And then the bank also compensates Control. So that's how everybody makes out for this transaction. So that's all I have. Questions, be glad to answer. Next steps, if anyone would like to find out more about it, would typically be with your team, whoever you feel is appropriate, payroll manager, accounts payable manager, controller, yourself, whoever it may be, as well as someone from control to demonstrate the platform, go through sample transactions, and answer any of your questions.
So Gary, the supplier, if I'm understanding it, pays the 1.5% that rebate. Is that correct?
Yeah. So the supplier in this case, when they accept that credit card payment, they're not paying any more than they typically would for any other transaction. So it's the same rate. It's less than they would accept with American Express, which is typically more. So the fee that they're paying is the same as they would get with any transaction.
Okay. And one person commented, they said, we find that many companies will not accept credit cards or virtual cards, and government agencies often will surcharge if you're using a credit card. How do you get around that, or is that your experience as well?
Well, certainly there's going to be some that will, decline to accept a virtual card. But as I said, the average being 26% of the volume will. Every business, some are going to be a little bit different. Some that it's going to come in at 15%, 20%. We've seen some as high as 70%. So it just averages out to 26. They will all be approached. Typically, if a client has some particular suppliers that they don't want even have them be asked, that's fine. They don't have to be, but for the ones that decline it, that's fine. We're just looking at averages.
Mm-hmm. And what's the benefit or incentive to the supplier for agreeing to accept the virtual card if presently they don't?
Well, there's a couple things. One being that they do want to keep their customers happy. They also do get a benefit in the reconciliation process when they receive payments this way versus a check or ACH. Many suppliers feel that there is some reduced time and reduced headaches in that process. So for them, it's a trade-off, and it's worthwhile.
Okay. Yeah, that's helpful. Thank you. And a question, just going back, and again, I should encourage the audience to type in any questions that you have. But going back to Ryan at Payrock, a question that came in from the audience is, are you implying that some of the folks out there like Chase Payment Tech, First Data, Heartland are not presently actively managing interchange for their customers?
That is correct.
So the fact that they're not doing it opens the opportunity for somebody like you or alternative firm, but somebody to fill that gap.
Yeah, if someone has not reached out and actively discussed dollars that can be saved by best practices, then they're not managing interchange for their client relationship.
Okay. Yeah, that's helpful. Thank you. And for Gary, a question for you in terms of the payable side. How is what you're doing in terms of a virtual card payment that you're talking about different or better than me just calling up to the vendor and paying with a credit card that I presently already have in my wallet?
Well, typically, that type of transaction is more time consuming, and it's not as secure. There are some companies who use the credit cards as a P card or purchase card, and it's a little bit different use. So we're not trying to replace that. And then there's some that have other benefits, such as, rewards and things like that. But typically for a large business that has, potentially hundreds, if not thousands of suppliers, to pay a lot of them with that method of, calling them and using their credit card, it's just not really practical. It's a lot of time. And also, this is a process that is the money's coming from their bank, so it's not a true credit transaction where, if they're using a credit card, that credit card is only going to have a certain amount of credit available and would not be able to pay, hundreds of suppliers.
Okay. Yeah, thank you. Question from the audience, maybe you can just add some clarity to this question here, but they say, what is the float? And then they say, are you trading zero float for the 1.5% discount?
Well, the flow, I guess the flow would depend on what they're referring to. If they're referring to the time that they are, mailing the check and then it's actually deposited versus the time that they have processed a virtual payment, if that's what they are concerned about, they can control the timeline of when that virtual payment is processed. So, for example, if they're going to mail the check and expect it to be deposited 3-4 days later, they can control the timing of when that virtual payment goes out and just make that 3 or 4 days later if they choose.
Mm-hmm. That makes sense. I think they clarified here and said, for instance, when you call company suppliers, you're telling them you'll get paid in 1 to 2 days, and for a fee of 2%, because they would now have the credit card fee or the virtual card fee.
Right. So there are cases where if their discount for paying that way is more beneficial than virtual payment, then in that case, yeah, we would recommend that they don't make that change in that particular situation.
So a higher level question, Gary, for you, if more and more customers start requesting that their suppliers adopt virtual cards or credit card payments, and more suppliers start accepting it and payment that way, is it ultimately going to lead to increased costs that get passed along to us as the payer of the cards? Or how do you see that all playing out over time?
Most businesses, their attitude or approach in most cases is that they understand that the credit card processing fees are part of the cost of doing business, and they build those fees, into their business model. So they know, how many customers or what percentage of their customers are going to pay with a credit card, and that's just kind of built into what they do. And it's going more and more in that direction. And it doesn't really come up very often as an objection.
Okay. And Gary, you mentioned those 4 banks, U.S. Bank being one. I think there were some others that you're partnered with. And a question that somebody asked is, what if your company does not partner with any of these banks?
Explain that. Say that question again.
They just asked, what if your company does not partner with one of these banks, their company?
Oh, right. So that's part of what I had mentioned was they don't have to change banks at all. That this is not anything where they're changing bank partners. They are just using those banks for the virtual card transaction. So for a typical transaction, the way it's working is let's say they're paying 2 invoices for $10,000. That money's going from their bank, the customer's bank, to one of the partner banks. So let's say it's U.S. Bank, and then it's getting processed through the virtual card. So there's no need for them to change banks.
Okay. Thanks. And somebody else said, can you explain the reconciliation process in more depth? In their case, they use Dynamics GP, and they've tried this, and the reconciliation was a big problem apparently for them.
Yeah, so typically what we do on the second call is we would go through a detailed transaction and a demonstration of the platform to show exactly how that would all work. So that's really one of the biggest reasons for the second call, to go through a full detail of the platform, specific questions that relate to their accounting software. Very difficult for me to answer it without knowing more of the details of the question.
Okay. Yeah, so that's better handled in a one-on-one call.
Yes, exactly.
How the process would impact each firm uniquely. Okay.
Right.
And somebody said question about oh, go ahead.
I'm sorry, but I'll just say this: there are, with a million different suppliers being paid and over 20,000 businesses, and all the different software providers that are already part of the control process. We have kind of figured out the way to do it with each one. So when that second call occurs and they get a demo of the platform, they would see specifically exactly how it would all tie together.
Mm-hmm. And Ryan, I'm just curious from your perspective, because you're kind of on the other side of the transaction, so to speak, from where Gary is and what he's talking about. What would you do in your case in terms of trying to drive down credit card fees? Maybe if you were advising one of the vendors who's now chosen to accept virtual cards.
I think it's a great option. I don't think we ever get away from consumers wanting to use their card as we become a more points-driven society. I don't think that it ever goes away. But when I take off my payment processing hat and I put on my consultative hat and just think of what's best for our clients, regardless, I think it's an excellent way to cut down costs. 100%. We actually have clients that we would refer to Gary and his firm in that case, because at the end of the day, if they can't control costs in a specific area, it's ultimately hurting their business. And we want to see these businesses succeed, whether they're, doing 100% on card or doing some on closed loop like that. So, whatever's good for the client is kind of the approach that we take.
Okay. Yeah, thanks, Ryan. Another question for you that somebody brought up. They just said, what is the information that they can enter to reduce fees from their merchant processor? And you mentioned that adding taxes and ID information may reduce fees.
Yeah, so that's what we call level 2 processing. There's a number of different ways. For example, holding on to an authorization longer than 24 hours could affect a downgrade. In addition, there's such thing as level 3 processing, which is about 60 data points in a transaction, and that may be familiar to some of you folks on this call. But basically, there's a few different ways that information can be passed, and if merchants are manually doing this and it's not being pre-populated and passed in the transaction in an automated manner, those are the things that we've developed in-house from a technology perspective to pre-populate. As you can imagine, entering in 60 data points on a credit card transaction for a level 3 processing merchant could be costly and time consuming. And our technology pre-populates, auto-fills that within seconds to push that data to the card issuer, so they're able to get the lowest possible interchange qualification on that sale.
All right, thank you. And Gary, back to you for just a second here in our last few minutes. Another question that came in just said, for e-commerce transactions, is language needed on the website informing the customers of the service fee? And is it difficult to add check payment options to the e-commerce site?
Well, the vendor supplier, they would be notified of the change in the payment structure. So once they agree to accept the virtual card, they're going to understand and know what the fee is.
Okay. And then somebody else said, how many companies like Control are in this space presently? And I guess in their experience, they seem to get a lot of phone calls from customers that like this that are attempting the same thing. And along that lines, is the rate at 2.5%? Is that split of the rate a negotiated? I'm trying to figure out the question. Is the rate of 2.5% and split of the rate a negotiation based on AP volume?
No, the 2.5% was just the number that was used as an example for the cost of the transaction. So that 2.5% is the total that is being split between the bank, the merchant processor, and Visa MasterCard. To the 1.5 or 150 basis points is the amount that's going back to the client. To answer your other question, I don't think there's that many companies doing this. Mostly, from what I see, are banks, but not third-party companies. At least I don't run into them very often.
Okay. Well, very good, guys. In the last couple minutes here, Ryan, I guess I'd just turn it back to you to kind of share your big takeaway that you'd like people to leave the call from in terms of educational takeaway.
Yeah, I appreciate that. Again, if you haven't had a certified payment professional, and a lot of you may say, well, our CFO shops us out, or, we do this every 6 months, or it's been a while. But if you haven't taken a look in the past 3 or 6 months, every April and October, new interchange rates get introduced to the market. Give us a call. Free analysis. We just take a look at your last month's statement. We do a free analysis on it. And if the savings warrant a second conversation, let's have that second conversation. If you say X amount of dollars just isn't worth having a second conversation, then you know what? At least you got a free look under the hood by the right mechanic. And they told you with clarity what you had going on. And really, that's all we're here to do is get free analyses. And if folks are happy with the savings, let's talk about, what that looks like next.
Thanks, Ryan. And Gary, kind of same for you, a big takeaway.
Yeah, very, very similar. We do the same thing as far as a free analysis. The second call that I alluded to is something that we can take a closer look at the organization and see exactly, they can see exactly how the platform works and ask any questions that they would like. I'd say the key is, it's worthwhile to take a look at because let's say you invest 30 minutes of your time to take a look at it, and then you decide that it's not the right fit. Well, what have you lost? 30 minutes of your time. But if it does work out and it does work for your business, you stand to gain literally millions of dollars, hundreds of thousands at least, millions, depending on the size of your company and the amount of time that we're looking at. Is the upside. So it's certainly worth exploring it and seeing whether it works for your business.
Well, Ryan, Gary, thank you very much for all your insights here today. For the audience, you can see on my screen their contact information. They would love to field any additional questions you may have. I tried to ask many of the questions, but I know I didn't get to every single one. So please feel free to drop them a note and they'll be happy to respond. Appreciate you being on the call. I did record this and I'll send out a link to the rebroadcast. So should you want to forward this on to somebody else in your organization who would like to view it, and I'll also send out the respective slide decks of each of these people so you have those for your reference too. Hope you found this to be of good educational value. I think credit cards are a big area where we spend money, and also, as Gary said, opportunity to potentially bring more dollars to the bottom line. So being creative about ways that we can turn credit cards more into a profit center for us, I think is useful, however that may look at the end of the day. So again, Larry, Ryan, Gary, thank you guys very much and wish everybody a very good day. Goodbye.
Thank you.